Good morning, good afternoon, good evening. So my camera on. Yes. Good morning, good afternoon, good evening. I welcome you all to this seminar titled Generating Alpha on Top of Beta. I greet you all. Can you hear me? If you could hear me, could you just say yes in the chat, please? If you could hear me clearly, if I need to speak louder, just let me know in the chat, please. Okay, perfect. Perfect. Okay, awesome. I think I'll just wait for 2 more minutes before we get started. I'm on Nigerian time, so let's just wait for another 2 minutes, then we'll get started. Thank you everyone for confirming you can hear me. Thank you. So I'll just wait 2 more minutes and we can get started. 2 more minutes. And I think I also left I created like a questions chat box for this webinar. So if you have any questions, please feel free to drop them in. Feel free. If we have time, I'll go through all of them after the walkthrough. So feel free to drop your questions, please. Feel free. I want everybody to leave this webinar empowered and informed. We're going to dissect this title. The title looks meaty, loafy, but by the time we leave here today, it will be clear. Everything will be clear. This is just a marketing gimmick. We'll make everything clear. Okay, we have 1 more minute and we'll get started. So yes, so let's just bear with me. You're welcome, Mr. Peter. You're welcome.
Good evening, sir. Thank you, sir.
We're just waiting for 1 more minute, then we'll get started. 1 more minute, then we'll get started.
Okay.
I want to respect everybody's time. Yes.
Thank you very much.
Good evening, Abiola.
Good evening. I didn't see who that is. Sorry, who's that? Who was that?
Michael.
Michael, you're welcome. You're welcome. You're welcome.
Thank
You're
you.
welcome. You're welcome. Thank you for joining. Can see
Ah.
Busayo too. Busayo, you're welcome. You're welcome. Think we'll get started. Get started. Every once in a while, I have to admit people. I don't know if there's a way I can make this automated, but let's get started anyway. Before I get into the meat of today's webinar, again, I want to thank all of you for attending. Could have been doing many other things, but you took, a few hours of today to listen to me speak. I first want to thank and acknowledge the SMI community, their leadership for even giving me this room to be able to speak. And again, this webinar is to also support the goal of what the SMI community is about, which is financial education for the Nigerian community at large, right? That's what this webinar is about, but giving a broader exposure to even outside Nigeria. And some of the principles from this webinar also apply in Nigeria. It's just that there'll be more emphasis on the global market. The market is beyond Nigeria, but the principles, the foundation from this webinar can also be applied to the Nigerian market. The Nigerian market is not on its own. It's not sitting on an island on its own. It's all part of the global financial market. So I just want to thank you for your support and trust for even allowing me this, this audience. I also want to introduce myself, before I even start, yes, I need to record. I'm glad I remembered that today. So let me start recording also. It's important I record this. Just record button. Yes. Okay, perfect. So I just want to introduce myself, right? It's important, you know who is talking to you, and it's all good. So my name is Abiola Obembe, and I have 5 years of experience delivering data science and predictive analytics solution in Canada. I'm also passionate about building systematic and data-driven investment strategies. I'm the founder of Data Vesting Community. I'm also the creator of Talk Stocks with Me. It's a YouTube channel where I specialize in teaching technical analysis and also performing institutional market breadth and market internals analysis across different markets, not only Nigeria. Nigeria is part of it. So I'm showing how institutions perform market analysis to understand the health of the market, right? The market is not only what we see, the market did 2% today or 10%, it's more than that. You need to be able to open the hood of the market to see how the engines are firing. So these are part of what I do on my YouTube channel. And my mission or my goal is to bridge the gap between data science and investing by helping investors make evidence-based decisions rather than emotional ones, right? We need to be able to move beyond acting emotionally. We need to be able to use evidence, which is data, to make decisions, right? With financial decisions. It shouldn't be different when it comes to financing, or when it comes to our finances. That being said, why did I call for this webinar? What is the purpose of this webinar? Right? The goal is simple. The goal, when we're going to leave here today, the goal is simple, right? First of all, most retail investors, like me, like you, we focus on buying stocks. What stocks are we buying? What are we supposed to buy? I want you to know that professional investors focus on building systems that consistently grow wealth over time. You can see the difference. One party is looking for what stock should I buy? Another party is looking for or is building a system that he can consistently grow wealth over time. This webinar is going to introduce how institutions approach investing and how you can apply similar principles to your own investing. We're going to use the US market as a case study. And I'm happy to talk about Nigerian market maybe in the, when we get to the questions and answer section and see how we can apply it. But I've prepared this webinar specifically for the US market, but I'm happy to talk about how we can apply it in the Nigerian market. We're going to explore how institutions start with market exposure. So when I say beta means market exposure. So meaning doing nothing, you have beta before they start seeking alpha. Alpha is then the extra on top. So think of it like a cake. You have the real one, which is made of flour, and you have the icing. So the real cake, which is made of flour, is your beta. The icing is alpha. You know, some people eat cake even without icing, right? So alpha is not necessarily important. It depends on how conservative or aggressive you are. And also, we're also going to look at how I combine both alpha and beta through systematic trading. I'm also going to show you why data and probability matter more than prediction. So rather than trying to predict the top or the bottom, I'll show you why when you work with data and probability, you are going to be more consistent and you'll be able to, trade or invest in the long run. You'll be successful over a long term rather than today you are right, tomorrow what is the hot stock? No, you shouldn't work that way. Basically, we're going to leave here not trying to copy hedge funds, but trying to think more like them. That should be the goal of everybody living here today. We need to leave this webinar with a different mindset about investing. Now that the housekeeping is done, let's get into the outline of today's webinar. One more point before we get into this webinar. This is not a webinar on technical analysis or how to trade options or how to pick options. No, not at all. This is a webinar about building repeatable investment framework where beta which is the market, the overall market, provides the foundation. So that's your foundation of your portfolio. Then the A line, which is my own alpha. This is a system that I created for myself, and this is what gives me alpha. My alpha identifies the stock, and I express that alpha using options. Not just any options, I'm looking for options pricing inefficiency. So the market also gives gifts to people who know what they are looking for. That is what I look for to express my alpha more efficiently. Enough with the housekeeping. Let's get into the outline of today's webinar. So this is what we are going to go through. You just have 5 sections, right? And the first one is going to be what I've been able to understand, with my discussion with my friends, with my family, and even every other, like any person I've met in this journey of financing, right, or investing. What's the chase, Then we're going to look at owning beta first. We are now going to explore finding alpha with the A line. The A line, that is just one way of finding alpha. It's not the only way, but that's the way I have embraced. And I'm showing it to everyone, See it. If you like it, that's great. If you don't like it, it's not a problem. But there are other ways to express alpha. This is just one way. Then we are going to look at what do I mean by expressing my alpha through option price inefficiency. We're going to touch on that. And lastly, we are going to put everything together, all what we've learned, from why most investors chase the wrong thing, why you should own beta first, finding alpha and expressing alpha. We're going to put everything together so you can leave this meeting with a roadmap of what you should be doing going forward. Now we're going to chapter 1. And the first thing about chapter 1 is I've identified 2 problems, discussing with people, discussing with market participants. First of all, many of us don't know the difference between investing and trading. What does that mean? Most times, when we're investing, we look at it like we are trading. And when we are trading, we look at it like we're investing. We are not able to separate the two, right? That's the first problem I've noticed while discussing with people. The way you operate when you are investing, when you are looking at a stock you are investing in should be different from the way when you are trading. That's the first major culprit. The second point that I've noticed is most people are unable to outperform the market. Why? Because they are looking for alpha first instead of beta. What do I mean by alpha? They are looking for the next hot stock. They are looking for the next Tesla, the next Nvidia, the next penny stock. No. You should seek beta first. That is what the institutions do. They seek beta first. Then they look for alpha. Why should you not seek alpha first? Because it is a difficult job to consistently pick winning stocks. It is a difficult job. It's not that it's not possible. Warren Buffett does it through value investing. A few of the people also on this call, they do that, right? But my point, it's not an easy job. So rather than trying to first seek alpha, first guarantee beta, which is the market, own the entire market. We're going to talk about what I mean by owning the entire market. So this is if you look at this picture, this is an investor here. He's already sitting on beta. So whether the market is doing bad or not, he's getting the overall market returns. And then he's looking for alpha to outperform the market. Many of us don't even beat the market. That is where I'm starting from. You need to first at least get what the market is giving you before you start looking for alpha. So alpha will be the icing on the cake. So my message from this slide is instead of replacing beta, which is the market's return, build on top of it, right? So make sure you get market returns first in your portfolio before you start looking for that shiny stock. that shiny stock that a YouTuber might tell you, or wherever you are going to find it from, right? Maybe you hear it from the barber store. I don't know where you get your hot picks from, but you need to first guarantee market returns before you start looking for the hot stock. That is clear, right? Now let's move into the next chapter. What is beta that I've been talking about? Beta. Beta means own the market, own the overall market. And you are able to do that. The US market and a few other markets have made life easy for investors. By buying a single index fund, you own all the stocks in a specific jurisdiction. So, for example, if you buy the total market ETF for the US, you own all the US companies. You don't need to be chipping financial statements to be looking for P/E ratio, or you don't need to be plotting the charts to do technical analysis. You just buy it and you chill. Why does it work? It's self-cleansing. What does that mean? There are more than 500 stocks, for example, in the US. The fund managers always perform their roles of filtering for the best 500 at every time. I'm focusing on the S&P 500. So they are saving you the job of going through the financial statement to be picking where the hot stock is, or which stocks have value, or which stocks have the potential to grow. They've done that job for you. Your job is to just every month, if you get your salary or however you want to invest, just be investing into the fund and you get market returns. That is why, please, moving forward, ensure you seek the overall market return. And we're going to see how the market has been generous over the last 5 years in the next slide. So have that foundation and build on top of that, right? And because you see you are building on top of the market, you don't have to be greedy. Because if the market is going to give you maybe 10% every year, what you need is extra, extra, extra on top of that, right? So that's the goal of owning the market first. That is your foundation. Then you build on top of that. So never let the search of alpha prevent you from owning the market. Everybody should have this in his portfolio every time when they are sleeping. This should be working for you and growing your wealth for you. These are 5 index funds that, they are a foundation of my community. People own a variant of this 5 or all of them, right? This graph is showing you how they've performed in the last 5 years. So you are doing nothing. You are just buying this and you are going to bed. If you had put your money in SPY in the last 5 years, your portfolio will have done 66%. That's the meaning of this. If you have put your money in QQQ in the last 5 years, you would have attained 81%. And you have done nothing. All you've done is just buy this and go to bed. It does not dump like when a company will release earnings and maybe because of forward guidance, your stock would dump 15%. If you have a sizable portfolio, your portfolio should not be dropping 15%, 10%. That is not how to grow wealth, right? You need to put your money into something cool as your foundation, and then you build on top of that. So each of these, they are available online. You can go to Google and type SPY, and you will see all the individual stocks that are there. You will see anything you want to know about it. How has it performed in the last 1 year, 6 months, even from its history, the marks. Which companies are within each of them? You will see it online. It's all available. It's not a black box. The world is no longer a black box, right? Finance has been democratized. So it's not something that is held. It's not a knowledge that is held by a few. No, it's available. So I'm just showing you that. So your goal is after 5 years, you have 66.35 because you own beta. By looking for alpha, you are just adding on top of SPY on beta. So you already have 66%. You've grown your wealth 66%. The alpha is just adding on top of this. The problem is that many people don't even have not achieved many people, not everyone, have not even achieved 66% in the 5 year, in the last 5 years in their portfolio. I'm not saying individual stock. Yeah, some people might have Microsoft that has done 100% in their portfolio, but when you look at their overall portfolio, they've not done 66%. So it's not by having one stock or two stocks in your portfolio do 66% we are talking about. We are talking about your portfolio. You put $1,000 there. It has grown by 66%, not one stock in your portfolio. It's your portfolio. This is the big picture. Portfolio, not the stock you have. It's portfolio, right? So this is why I'm saying beta is important. Own the market, then build on top of the market. One of the products I mentioned there, this is S&P 500, it's called SPY. What I've done here is I've collected the performance of this ETF from 1928. So this product or this ETF, which is a basket of stocks, has been available in the public since 1928. And this is the annual performance since 1928 till date, right? What I want you to see is there are more bars where this product has closed positively versus negatively. This is from 1928. How many bars are below zero? I can count them versus the bars that are above zero. This is cheats. This is cheat code for investors. This will save you a lot of heavy lifting because you see most years you are guaranteed a positive return by just putting your money here. That's what this graph is showing you. I would then aggregate this data more for you because this is just a visual representation of the annual performance of this ETF. Now, if you follow me to the next slide. From 1928 to 2025, to the end of 2025, the average annual return is 8%. So it means if you buy S&P 500, the annual return on your portfolio is 8%. The median return is 11.59. And there was a year this thing gave investors 46.59%. So by doing nothing, there was a year you got 46.59. And now there was also a year it dumped by 47%. So there's still risk, right? It's not like it's perfect. There's still risk. But we will get to that in the next slide. And the probability, if you put your money in S&P 500, that you will make money that year in your portfolio is 67%. So this is not a yield, a EJ. This is not head or tail. This is skewed more that you will make money in your portfolio. And this statistics here shows that even fund managers, the best of the best, over a 10-year period, they are able to outperform S&P 500. Over a 10-year period. They might beat 1 year, 2 years, but if you look at over a 10-year period, they are unable to outperform this index. I only picked one for you, right? But if you notice in the previous slide, I showed you there are more than one. The data for all of them is available. I have it, but I'm just focusing on one just to show you the pros and the cons of owning the market. So now, when you invest in S&P 500, you own all the top 500 companies in the United States, free of charge. You grow with them. You grow your wealth with them. Now, this minus 47%, which is possible, is a challenge for some of us. Imagine you are 3 years to retirement, and by investing in your portfolio, you have achieved $1 million, just to give that example. And you meet this year where the market dropped 47%. So it means your $1 million has become, let's just rough it up to maybe $30,000. And you are 3 years to retirement. That's a problem. That's a big problem. That is why you also don't have to sleep on the wheel because you are owning the market. And that is where I've come up with some strategies that also prevent people from experiencing a 47% dump in their portfolio. But we still guarantee them 67%, a minimum of 67% chance of making money in their portfolio every year. An average of 8% as their beta, right? How did I do that? We will see that in the next slide. Because I know everybody's wealth journey is unique. Your risk management should be too. What do I mean by that? Some people have big stack of cash, maybe $500,000, $100,000 that they want to work for them. And they put it in this beta, which is the market. This is the returns from the market. I just took a snapshot to show you what I've done here. Sometime between 2007 and 2009, you can see the market lost 50. This is the period they lost that 47%. So this is just like a rough. But can you see, I've gone with strategies that tell me when, pardon my French, the shit is about to hit the fan. Then you pack your cash, because you see, that's why I say your wealth journey is different. Someone who has big stack of cash is not supposed to experience 30% dump. He is not. So the way he would react will be different from somebody who is building up wealth. So if you're in a stage you are building wealth, maybe 1,000, 2,000, during this period, you should even be more aggressive. You should buy more because now the market is cheap. But for people who have built up wealth, they are close to retirement, this that I've built will also let you know, okay, let's come out now. Let's keep our money. And when the coast is clear again, will let me know you can get back in, get back to beta. This is how the funds, this is how the managers, this is how they operate. They don't just sit down because you remember they are dealing with huge capital. They can't afford to be careless or reckless, right? So they have to protect capital. So in periods of beta, this is another one here where was more recent in 2020. You can see there was like a 26% dump. Institutions will rotate out of beta to like a fixed income ETF. And when the coast is clear again, they will enter the market. Retail will sit down here and be praying. Oh, market will come back. Oh, market will come back. Oh, and each of these candles is a month. Roughly, these are 12 months here of pain for big capital. But for small capital, this is an opportunity for you to buy cheap. That is why I said your wealth journey is different. Your risk management should be too. So there are algorithms that also help you grow with beta, with the market, and also move away from the market when the market is weak. So market is not always strong all the time. But the idea is when the market is healthy, grow your wealth with the market. Right? And when the market is weak, pivot into something safer. And when the market is healthy, jump back in. I'm talking about big capital. Small capital is an opportunity for you to buy cheap. And what my system is telling me, by following this, I've even given you 77% probability of making money. Remember, when you do nothing, it was 67. Now, by being more proactive, I've helped you increase that to 78% with the same expected returns per year. The only difference here is I've helped you avoid periods when the market is weak. That's when beta is weak. Now that we know there's beta gives you, guaranteed market returns. Sometimes too, beta can be weak. Beta is not always going to be up all the time, right? And what this is showing you here, I think this is important. You're seeing 9 7 out of 9. What does this mean? It means from the history. This ETF that I'm showing here has been in the market since 2007 or 2003. I can't remember. It's telling you there are only 9 times where the overall market has been weak. So my point that this is not something you'll be jumping in and jumping out. No. So over 30 years, if I'm not mistaken, only 9 times has the system flagged that the market is weak. For you who has big capital to just step out, and wait for the market to heal before you get back. So I want to make it that even when you are trying to perform risk management, you are not going to be jumping out today, jump back in tomorrow. No. In over 30 years, if we look at from 2007 to 2026, only 9 times. So it's not something that is actively, because you are growing wealth. You are not trading. You are growing wealth. So it's not something you are doing on and off on, right? I wanted to call that clear. So with that clear, with that in mind, the message here is that your portfolio should reflect you, not the crowd. For some people, it pays them to be in the market here, to even be more aggressive buying, because now the market is cheap. But for those who have sizable wealth, you are not supposed to really be here, because basically what you are doing is you are transferring wealth to the person who is just entering the market at this period. I don't transfer wealth to anybody. No. You should avoid transferring wealth. So that is what this slide is about. Now we are going to the heavy lifting, which is finding alpha. So we already talked about beta. You know why you should have beta in your portfolio. How can you look for alpha? There are many ways to look for alpha. It's not only A line. One way to look for alpha is through dividend investing. So you invest in stocks that pay you a dividend every month. So that is extra on top of beta. For me, I get my alpha through something I call the A line. And the A line is my own framework that reflects the way I look at the stock market, whether the NGX, Canadian market, US market, Australian market, you name it. The A line answers one question for me. Does this stock deserve my capital? That is the question it's answering for me. And to answer that question, the A line is looking at all these stacked together. How is the market regime of the country that you want to go and look for your alpha? Should you be looking for opportunities there or not? That's what all this is answering for me. You can see that. It's even looking at fundamentals, looking at what analysts are saying, looking at seasonality. There's a lot involved. Then it's looking at the technical profile. It is only when a stock meets all this that it deserves my capital. That means the alpha I'm looking for. You could pass all this but fail here, then you don't deserve my capital. I hope you can see that. All this must be answered. But where does it start from? It starts from looking for momentum, right? We know the index, which is the beta, comprises of stocks. It is the stocks that are pushing the index. The index is not moving by itself. The stocks momentum, or why it's going up, is because of some stocks. The A line will find those stocks that are making the index move. And it's all based on data performance. When it finds those stocks are sent to the doctor, which is, quotes, a fake doctor, but that's technical analysis. He wants to check that they are healthy from their head to their toe. If you are healthy from the head and to the stomach, but your knee is bad, it will drop you out. You must pass everything. Then the airline will say, good, Abiola, this deserves your capital. Right? That's how you go about it. From the index that is moving, you are looking for the uncommon winners, the big guy, the guys making that index move. We are not just picking stock from from YouTube or from the barber. You are going through a process. After those stocks have been identified that they deserve your capital, this is what it looks like. This is what comes out to me from the program. The program is telling me as at 31st of July, that was yesterday, AMP deserves your attention. CPay deserves your attention. MET deserves your attention. Okay? Why do they deserve my attention? Because they've passed all what I showed in the previous slide. What are analysts even saying about them? Apart from me, I'm just a nobody, right? Experts from, who are paid, who are professional, 5 of them said it's a strong buy. 5 of them said it's a buy. 1 said it's a sell. You have this evidence to also make your decision. This score here is telling you the CGPA, like when we're in university, where we have grades. This is the grade of this stock versus the benchmark. Remember, there's a benchmark, the beta, which is the market. This is telling you how strong is this stock versus you buying the entire market. Because remember, you are looking for alpha. You are looking for the fast horse. So this is telling you I'm 1.37 faster than the market. I'm 1.32 faster than the market. That's what this score is telling you. Also, you want to know, in the last 10 years, if I buy the same stock at the same time you are telling me, would I have been right? This is telling you 60%, so 6 out of 10 times during the same window. If you just buy the stock and hold for 20 days, you would have made money. That's what this is telling you. Also, rather than you reading newspaper or searching the internet to like, why is this stock good? This A-line will tell you the reason. So this is telling you AMP have beaten earnings. That means their earnings was spectacular. That is why I'm thinking it's worth your capital, right? So you have evidence to make up, okay, this stock is going to give me alpha, right? So one way you can go about it is go and buy the stock to get your alpha. That is the crude way. That is a local way of finding alpha. The best way now is, now that you've seen the stock, you want to express the alpha in an efficient way. This is where options come into play. Before that, this is just a live sample of some of the trades that we've done using alpha. One thing I want to call out here is that me personally, when I first started looking for alpha, I'm only looking for 3% because I already have beta. But what I'm showing you here is that all these 3% were hit. What I ever found, these ones have even gone past my 3%. Like you see this one here, 57%. This one, 36. I'm not looking to grow my wealth through alpha. I'm just looking to add on top of beta. So I'm not here to sit down and I'm just looking to add on top of my alpha. But this is showing you that from 2025, when I started, because this is 2025, you can see it. You can see that I've got my alpha, but these ones have even done more than alpha. You can see 131. You can see 116%. So you can go and check anyone. Go and check if I'm lying. This here. You can see the price that the signal was fired, the price I got out, and the price it has gone till today. But I'm no longer in some of them. Some 85%. You can see 116, 481, if I'm not mistaken. 2248, right? So this is to show you that by being disciplined, you can find alpha on top of your beta, right? That's what this is showing you. This is when I was trading it as a stock rather than looking for options. Then I learned from the big guys that from the you use options to express it because it's less capital intensive and it's more efficient. And that's where that brings us to expressing alpha through options. So You can express alpha through buying the stocks. Don't get me wrong. But the edge is now expressing it looking through options and finding pricing inefficiency. So you're not just buying any option. You are looking for the gifts that the market give. The market makers are smart. They reward people, right? They reward people as well as they punish. So like I said, you have the alpha stock. You have two options. There's a stock XYZ. You can go and buy the stock. You will still make money. You'll get your alpha. Or you can go through options, which is more efficient. Basically, you have a stock XYZ. You can buy the stock or you can express the same bias through options. Options provide for a defined risk. So you know already how much your risk is because the price you pay for the options is your risk. And it is always cheaper than buying the stock because it's basically a contract that if so, I will take it from you. So you see that you even spend less when you are doing options than if you buy the stock. And I will show you in the next slide that I've been able to express my bias more efficiently. So I don't want to talk about what an options is. I mean, if it's a question here, I expect some people know, some people don't know, but if it's a question I can talk about. But like I said, this webinar is not about options. I'm just showing you how to express bias. This is a sample of trades that I've done with options. You can see, even though I found the stocks that are alpha, I will only trade them if I see the price inefficiency, where the market is giving gifts. So with options, you can either buy or you can either sell. When I've been selling options, I've been able to sell it and my win rate is 100%. When I'm buying options, you see I've done more buying 36 and my win rate is 75%. I even found that the times that I lost was because of the war. When the war started in America, that's when I lost because, it disturbed the market, really, I think it was sometime in April when the war first started in Iran, right? So this is how options it's less capital intensive and it's more efficient in expressing alpha, right? So that's why I went to show you with this slide. Now, let's put it all together. I've been speaking for the last, I've lost track of time, but now let's put everything together because I know it might have sounded like a lot. But what I want everybody to know, at least leaving this webinar, is you need to get market exposure. That is your beta. Just go and look for a low-cost passive index ETF. It could be for the US economy. It could also be for the whole world. They exist. Just one product, you own all the companies in the world. That will give you your beta. And you are doing nothing. You are going about your day as a teacher, as a doctor, as a pilot, as a pastor, whatever your profession is, go about it. Then it's if you are looking for extra, that is where alpha comes into play. And I said there are many ways to look for alpha. You could look for alpha through value investing, dividend investing. I used a line to find my own alpha. Rather than buying the stock, I use options. I don't just use any options. I look for price inefficiency when the market is giving gifts. If the market is not giving gifts, I will not buy you. I will look away because I'm not in a hurry. My beta is working for me. So I don't have to be desperate to pick any options. Retail traders just pick any options. That's how they lose money because they are greedy. The market is generous, but it doesn't give gifts every day. You have to know when it's giving gifts. When you now buy an options when it's giving gifts, remember, you didn't just pick the stock at random. The stock came from a process already that I showed you earlier. where it's answering, does this stock deserve my capital? After that answer was yes, then you went to look for options. You didn't pick any options. You looked for the options that was a gift by the market. And you already know your risk, which is the price you pay for the options. Alas. And you repeat this process day, week after week, and you grow your wealth. This is the investor's edge. Own beta, that's own the market. Find your alpha. I don't know what your alpha is. Find it. My alpha is A-line. Know how to express it efficiently and protect your capital. And that brings me to the end of the webinar.